What if I told you that on October 29th, 1929, Wall Street effectively died in a single day of pure panic when the New York Stock Exchange suffered a catastrophic collapse that erased billions in wealth in hours, a sum that would equal trillions in today's dollars, and that the real reason ordinary people are still paying for it nearly a century later is the institutional architecture of bailouts, moral hazard, and perpetual debt that was built from the ruins, and continues to shift the cost of elite speculation onto the public balance sheet through inflation, higher future taxes, and distorted asset prices. Yeah, you heard that right. Black Tuesday was not a random accident. It was the inevitable bursting of a decade-long speculative bubble fueled by reckless margin, lending overvalued stocks and a widespread belief in endless prosperity. And the reforms that followed did not end financial fragility. They simply redesigned it so that the public would forever subsidize the next crash. If you think the 1929 crash is just ancient history that has no bearing on your gas bill, your grocery prices, or your tax burden today, then you are about to get the rude awakening you did not know you needed. Because today, we are ripping open the day Wall Street died. The verified timeline of panic, selling the self-reinforcing downward spiral that triggered the Great Depression, and the deeper enduring consequence that explains why you still pay for it through the normalized cycle of boom-bust and rescue. Stick with me until the very last word, because the documented causes, the 25% unemployment, the thousands of bank failures, the creation of the Securities and Exchange Commission, the Federal Deposit Insurance Corporation, and the vastly expanded Federal Reserve powers and the way this framework turned private risk into public liability will leave you equal parts stunned and furious at how the system was rebuilt to protect the top while the bill lands on everyone else. If you're tired of watching your money quietly fund the next bailout while the people who caused the problems walk away richer, hit that subscribe button right now, turn on notifications, so you never miss these deep dives, and drop a comment below telling me whether you have ever felt the hidden cost of this moral hazard in your own finances, or if this explanation has you rethinking the entire idea of financial safety nets. I read every single comment, and we are building this conversation together as a community that demands the real story behind the crashes and the rescues. Welcome to Money's Hidden Past. Rich people lied. We fact-checked. Let us begin on the morning of October 29th, 1929, because the numbers alone tell the story of pure terror that unfolded on the floor of the New York Stock Exchange. Investors traded over 16 million shares in a single day, an unheard of volume at the time as panic selling swept through the market. The Dow Jones Industrial Average fell nearly 12% in hours closing at 198 after starting the day already battered from the previous sessions. Billions of dollars in paper wealth vanished in minutes, the equivalent of trillions in today's dollars, wiping out thousands of investors who had poured their life savings into stocks they believed could only go up. This was not a normal correction. It was the bursting of a decade-long speculative bubble that had inflated stock prices far beyond any reasonable valuation. Throughout the 1920s, easy credit and margin lending allowed ordinary citizens to borrow heavily to gamble on rising prices. Banks extended loans with as little as 10% down payment, meaning investors controlled 10 times their actual capital. When confidence cracked, even slightly, the margin calls began forcing people to sell stocks to cover their loans, which triggered more selling, which triggered more margin calls in a self-reinforcing downward spiral. The crash did not happen in isolation. It was the inevitable end of years of reckless speculation fueled by the widespread belief that prosperity was endless and that the market could defy gravity forever. The immediate human and economic devastation was staggering, and it marked the beginning of the Great Depression, a decade of economic ruin that reshaped the entire world. Unemployment soared to 25% by 1933, meaning 1 in 4 Americans who wanted work could not find it. Thousands of banks failed as panicked depositors withdrew their savings in waves of bank runs. Industrial production collapsed, global trade contracted sharply, and entire industries from farming to manufacturing ground to a halt. Families lost homes, farms, and savings overnight. Shanty towns called Hoovervilles sprang up in cities across the country as people who had once believed in the American dream found themselves homeless and desperate. The crash exposed the fragility of a financial system built on leverage and blind optimism. Banks had lent far beyond prudent limits, allowing speculation to run wild. When the bubble burst, the entire economy seized up because credit froze and confidence evaporated. This was not just a stock market event. It was a systemic failure that turned a severe recession into a global catastrophe, lasting more than 10 years and only truly ending with the economic mobilization of World War II. Yet the deeper and more enduring consequence, the reason ordinary people are still paying for it, nearly a century later, lies in the institutional architecture that emerged from the ruins. In response to the catastrophe, policymakers created new safeguards designed to stabilize the system and prevent future panics. The Securities and Exchange Commission was established in 1934 to regulate markets and prevent fraud and manipulation. The Federal Deposit Insurance Corporation was created in 1933 to insure bank deposits and stop runs on banks. The Federal Reserve saw its powers vastly expanded, including the ability to act more aggressively as a lender of last resort. On the surface, these reforms looked like progress. They aimed to protect ordinary citizens and restore trust. But they also institutionalized something far more dangerous, moral hazard, the implicit guarantee that large financial institutions would be rescued if they ever got into trouble again. The government had stepped in as the ultimate backstop, signaling to banks and investors that the downside risk of speculation would be borne by the public while the upside would remain private. This framework shifted risk from private speculators onto the public balance sheet, and it has defined financial policy ever since. The sarcastic truth that few textbooks admit is that 1929 did not end the era of financial fragility. It merely redesigned it. The bailouts, quantitative easing, and ever-rising national debt that have become normalized responses to every subsequent crisis are direct descendants of the post-crash reforms. When the 1987 crash hit, the Federal Reserve stepped in with liquidity. When the 2008 financial crisis threatened to bring down the entire system, the government provided trillions in bailouts, and the Federal Reserve launched repeated rounds of quantitative easing, creating money to buy assets and prop up markets. The same pattern repeated in 2020 during the pandemic with massive fiscal and monetary intervention. Each time the message was the same: the system is too big to fail, so the public will bear the cost. The tax we continue to pay is not a direct line item on our paychecks. It appears in the form of inflation that erodes savings, higher future taxes to service the national debt, distorted asset prices, that make housing and stocks less affordable for ordinary people, and recurring cycles of boom and bust that disproportionately burden wage earners and savers while protecting the institutions that caused the problems. The national debt, which stood at a fraction of gross domestic product before 1929, has exploded to more than $35 trillion today, in large part because of the repeated rescues that followed the original crash. Every time the system breaks, the public balance sheet expands and the bill gets passed forward. This is the cold arithmetic that explains why you still pay for 1929. The crash prompted reforms that stabilized the system in the short term but created permanent moral hazard. Banks and financial institutions now operate with the knowledge that if they take on too much risk, the government will step in to prevent systemic collapse. That guarantee encourages more leverage, more speculation, and more fragility over time. The cost of that speculation is socialized through inflation, higher taxes, and lost purchasing power, while the gains remain privatized. Wage earners and savers bear the brunt because they hold cash and fixed income assets that lose value in the rescue operations. Asset owners at the top capture the rebound because quantitative easing inflates stock and real estate prices. The cycle repeats because the institutional architecture designed after 1929 makes it inevitable. The crash did not kill the era of boom and bust. It simply turned the cost of elite speculation into a permanent levy on the broader public. The energetic reality that makes this story so infuriating is that the same people who benefit from the rescues are the ones who preach fiscal responsibility when it comes to social programs or worker protections. After every crisis, the narrative shifts to austerity for the public while the financial system receives another round of support. The 1929 crash exposed the dangers of unchecked speculation, but the response created a new danger, the expectation of rescue. That expectation has grown with each passing decade, turning what should be market discipline into public subsidy. The result is a financial system that privatizes gains and socializes losses, and the ordinary citizen pays the difference through eroded savings, higher prices, and a national debt that grows larger with every intervention. This is not ancient history. It is the framework that still governs how crises are handled today, and it explains why the bill from 1929 keeps arriving in your mailbox in the form of inflation taxes and economic instability. The mature recognition here is that 1929 was not the end of financial excess. It was the beginning of a redesigned system that protects the speculators at the expense of everyone else. The reforms that followed the crash were necessary to stop immediate panic, but they came with a hidden price tag that we are still paying nearly a century later. Understanding this mechanism does not mean rejecting all regulation or safety nets. It means recognizing that the current architecture encourages the very behavior that caused the original disaster and shifts the cost onto the public. The day Wall Street died in 1929 did not kill the speculation, it simply taught the system how to make the public pay for it forever. If this deep dive into the day Wall Street died in 1929, and the reason ordinary people are still paying for it through inflation taxes and moral hazard, fired you up about seeing the real long-term cost of financial crises, then do me a favor right now. Smash that like button to let the algorithm know this conversation matters. Share this video with every friend and family member who needs to understand how the system was rebuilt after the crash, and let us keep exposing what they do not want you to see. I will catch you in the next one, where we break down the next hidden chapter in the history of financial power and public cost. Until then, stay informed, stay skeptical, and remember that when Wall Street crashes, the bill does not disappear, it just gets passed to you.